Let's move on to next set of turnover ratios, that is working capital turnover ratio. As already indicated, we have some three ratios in this. Number one is inventory turnover ratio. Then we have debtors turnover ratio and creditors turnover ratio. So in this session, let's see how to find out inventory turnover ratio, debtors and creditors, all the three. Okay, to start with inventory turnover ratio. Now, what is the formula? Let me just give you the formula, then we'll appreciate it. The formula is cost of goods sold divided by average inventory. Cost of goods sold divided by average inventory gives us inventory turnover ratio. Now, what is this ratio, or what does it communicates? Okay, to understand, let's say the cost of goods sold for a company is, say, something like 100 million. Now, this is annual cost of goods sold. Annual cost of goods sold is 100 million. And the company keeps an average inventory. Let's say they keep an average inventory of 10 million. So now what you can infer is their annual cost of goods sold. For one full year, they have made some sales, and for that, the cost which they have incurred is 100 million. Okay, and in their inventory, they have inventory worth 10 million. So this 100 million represents one full year position, and this 10 million represents those stocks which were not yet cleared or not yet sold. Okay, so if I create a relationship between these two, that is 100 by 10, what I get is 10 times. It means this firm is keeping an inventory 10 million, and that 10 million inventory is rotated 10 times. So here you have annual cost of goods sold, that is 100 million. Now, probably this figure on standalone will not communicate anything serious for you, but let me give you some more number. Let's say the annual cost of goods sold is 100 million, and the average inventory which they keep when they were achieving this 100 million is, let's say, 50 million. Okay, annual cost of goods sold is 100 million, the average inventory which they are keeping is 50 million, and now if I create a relationship between these two by dividing 100 million by 50 million, I get 2 times. Now look at here, on an average they are maintaining inventory of 50 million, and one full year their total cost of goods sold is 100 million. It means they were able to rotate the inventory only 2 times in a year. Here they were able to rotate inventory 10 times in a year. Now, what is the difference? What makes sense? What is the benefit you get when inventory is rotated 10 times? What is the benefit you are losing when the inventory is rotated only 2 times? Let's understand that. Let me put it here. If inventory is rotated 10 times and if inventory is rotated only 2 times, if inventory is rotated 10 times, it means I am making sales 10 times, right? Every time I am making sales of goods worth 10 million. So 10 million into 10 times, let me just clear that. Sorry for that. Yeah. 10 million into 10 times is the cost of goods sold, that is 100 million. But the point which you have to understand is this entire 10 times is going to bring in profit. Okay, this 10 times is going to bring in profit. It means my profit making capacity is 10 times on this 10 million. But if I say my inventory turnover is 2 times, what is happening? I am going to make sale only 2 times, that is 50 million worth inventory is going out 2 times. So my annual cost of goods sold is 100 million. So my profit making or the ability to bring profit into the business is only 2 times. It means here the profit is coming frequently, whereas here the profit is coming only 2 times in a year, that is say something like every 6 months. It is coming like every 6 months. So I repeat, here the profit comes frequently, here the profit comes only every 6 months. And since the sale and rotation is happening, there will be good level of liquidity in the business, because there is a good amount of cash flow that is going to take place. But here everything is locked in inventory in 50 million for a period of almost 6 months. It means this business will suffer from, or it will have strained liquidity. It will have strained liquidity. Okay, so these are all the common implications. So what you have to understand is, whenever you calculate inventory turnover ratio, and if inventory turnover ratio is higher, it is a good sign, and if inventory turnover ratio is lower, it's a bad sign. I mean, the lower turnover ratio can lead to strained liquidity. It will lead to, the ability to make profit is coming down, the cash flows will not come, or cash flows will not happen, and there will be a strained liquidity position. But when the ratio is very high, you see a lot of aspects like there is going to be improvement in profit, there is going to be improved liquidity position, there is frequent movement of goods and frequent cash flows that are happening. Okay, so that's about inventory turnover ratio. Probably in the next session, I will take you through the debtors turnover and creditors turnover. I don't want to take it long here. Thank you.
Are you struggling in understanding financial management concepts like time value of money, financial ratio analysis, cash flow analysis, fund flow analysis, cost of capital and capital structuring decisions, capital budgeting, and working capital management? Then this course is for you. Financial Management, a complete study. One of the comprehensive course in financial management at the most affordable price with lifetime access. Explore and enroll now.